have Andrew Steffensmeyer joining me here this morning on a nice, brisk winter morning here in Nebraska. So we thought it was a good time here, getting to the end of January. It's hard to believe we're already there, almost coming into February here next week. So we're getting rolling here with tax filing season. The IRS is accepting e-filed returns right now. Currently, we're not able to quite yet, still waiting on our tax software and a few things, and then also, as we'll discuss here a little bit later, waiting on the state of Nebraska for some property tax credit information that they have on their website. So with that, we thought it was a good time to just do a couple things. One, just have a good refresher on current tax law, a couple items with that, and then also go on some new items, because as we all know, there's been a lot of new items that have popped up over the last couple of years, and there's a few new items that relate directly to the 2021 tax filing season. So with that, we're going to kick things off. But just a reminder, with GoToMeeting, you can submit questions to the chat box. So as you have any questions, please submit those. We will do our best to watch that, answer those questions. If we miss any or don't know the answer to them, we'll be sure to follow up with you after this webinar. So with that, Andrew, if you want to kick things off.
Yep. Thanks, Clint. Good morning, everybody. So we're just going to go through, I'm going to take you through the first few slides on some individual changes here. So yeah, just crazy that we're doing this webinar already. I know a year ago we were talking about PPP still, number 2. So it's good this year we have a little bit less tax change, but still quite a bit. So I'm going to take you through those changes and what you need to look out for. So yeah, just a few things that happened this past year. So we had the ARP, which is that American Rescue Plan Act, that was March of 21, and then the Consolidated Appropriations Act, which was the CAA back when, you know, December 2020, so we were about 9 months into the virus, the pandemic. So those two pieces of legislation, that's where most of these changes are coming from. So, you know, for 2021, you know, everybody knows about the child tax credit. Some of those letters, those 6419 letters, have started to hit people's mailboxes this last week. A lot of confusion with those, so we'll talk about those. Also, these EIP payments, that's that third stimulus program. So that was the program where this was the round 3 payment. So that was that $1,400 per person check that was either direct deposited or mailed, just really depends what the IRS had on file. And then also this year, another friendly tax change was if you do not itemize your deductions, you can still take a $600 charitable donation if you're married, or $300 if you're single. So that's another change. And then lastly, we'll talk about the RMDs a little bit, but the unemployment compensation last year, if you received unemployment, you didn't have to pay tax on the first 10,000, so that law change is no longer there. So you will pay tax on all your unemployment earnings this year. So I'd like to hit on these every year. These are just our tax brackets for, you know, you can see as it's laid out on the screen: single, married, head of household, married, filing separate. One thing we like to hit on is our tax brackets are always incremental. So if we take the single brackets on the left side of your screen, your first, you know, if you're a single taxpayer, your first 10,000 of taxable income is taxed at that 10%, and then from there, from your 10,000 of income to 40,000 of income is taxed at 12%. So if you wind up in the 24% bracket, that does not mean all your income is taxed at 24%. So we like to hit on that every year. These do increase every year just a little bit for inflation. Obviously, we know inflation's real. So these are just our updated brackets for 2021, and this is just on our income. So the next slide we'll go to, that's our capital gains rates. So how this bracket, or how the capital gains tax works, is a little bit different from our ordinary income. So in this case, we're going to look at that same single filer bracket on the left side. And so if you have qualified dividends, capital gains, if you have those plus your taxable income is less than this 40,000 number, you actually don't pay income tax on those capital gains. So really, in the case of a joint filer as well, you know, if you're in that 12% tax bracket, which is roughly this 80,000, any capital gains are virtually tax-free. So you can see for more middle income people to higher income, this, for on the joint 80,000 to 501, that's taxed at 15. And then, what we would say high net worth or high income folks, your capital gains rates are actually 20%. And just a caveat on that, that's just the federal rate. Nebraska doesn't care if it's capital gains or ordinary income. They will just tax you at the Nebraska rate, which is about 7%. Again, just a few things changed on the standard deductions this year. It just goes up a couple $100 every year. So, last year, we were sitting right at about 24,800. So this year we're at 25,100 for a joint couple. So those, again, they go up a couple $100 every year. So this is a big item today for individual taxpayers. So these advanced child tax credits. So how are they calculated, one, and then how are you getting these letters? So there's been a ton of confusion. I know we were reading an article a few days ago that some of these letters potentially might not be correct. So again, probably just ask your patience for 2021 on some of these items, just because we do want to get these correct. So whatever you did receive throughout 2021, we want to make sure we get it correct so we don't have any hiccups in the IRS trying to figure out what your refund should be or potentially holding a refund. So to kind of back up on the child tax credit, really what this, there were a few changes to the credit. So first of all, the credit did increase in value per child this year. So for the most part, any child under 5 years old, it used to be $2,000 per child. Now it's $3,600 per child. And so anybody 5 or older, now it's $3,000. It used to be $2,000. So the first change was that the credit increased in amount. The second change was whatever your new credit should be, they're paying you out half of that from July of 21 through December of 21. So it's really like getting your, if you're in a refund situation, you're essentially getting half of that child tax portion of your refund throughout the year. And so on this slide, I know it says married filing joint filers, everybody, anybody with kids is going to get this 6419 letter. So in the typical situation, husband and wife, both the husband and the wife will receive separate 6419 letters. So that's just going to say that each of them received roughly half of that credit if there was no opt-out situation involved. So another layer of confusion is you could have opted out of this system back when it started all the way through the end. So you might not have received all your payments. But again, we're relying on the 6419 letter to validate that. So again, when these letters come in, we need them for tax prep, but also you need to review them to make sure they accurately reflect what you received. One special situation the IRS has hit on, they updated their frequently asked questions on this, but a shared custody arrangement for, whether it's a divorced couple and one parent claims a child 1 year, the next is the other parent. So in that situation, when the IRS rolled this program out, they only had the 2020 and 2019 tax returns to work off of. So they would use your most recent. So in a lot of cases where it's shared custody, it's every other year. So if one parent was claiming them in 2020, well, the IRS assumed that that parent would also claim them in 21 to receive these credits. And so their stance is if you're getting child tax payments from, in 2021 and you shouldn't be, you should have opted out. And if you didn't opt out, it's most likely your responsibility to pay those back on the tax return. That's probably going to either, lower your refund or increase a balance due. So then on the flip side, that parent who actually will claim those kids on the 2021 return will just have a higher refund than what they expected.
Right. I did read though too that if you're under certain income limits, that you might not have to repay any of it back. Is that right?
Yes. Yeah, that is correct. So we don't have those phase outs on here, but essentially it is for like a married couple. I think it's like 60,000. If your income is less than 60,000 and you receive payments you shouldn't have, the IRS is basically saying we're not going to come after you for those. So again, married is 60,000 of income, singles I think are like 40,000 of income. So
Right.
you potentially might not have to pay those back. And then again, you know, changes in income from when you got these to when you file your return, you might have to pay a little bit of it back if your income increased in 21. So lot of things going on this year with the child tax credit.
Yeah, it certainly makes things a little bit more complicated just from a tracking standpoint, the fact that we got reconciled it on everybody's tax returns. So like Andrew said, it's really important that you get us those letter 6419s so we can have those when we prepare your tax return.
And the last thing on here, that Build Back Better Act, Clint's going to talk a little bit about that, but they want to re-implement this system if that Build Back Better would pass. I know that was a point of contention why it didn't pass, so we'll see what happens there.
Right. All right, moving on to some state and local tax issues. One of the new things that came out last year was the Nebraska Property Tax Credit, the Nebraska PTC. Last year, that credit amounted to 6% of the school district portion of your property taxes paid on the real estate taxes. So you can basically, you know, rule of thumb is the district tax is normally about half your total real estate taxes. So you took that times 6%, that was your credit last year. Now for 2021, they've significantly increased that credit based on the budget surplus. So for 2021's taxes, that credit is going to be 25.3%. So it's a pretty significant increase. So it's vital that you guys help us get that information. And we'll kind of go through what that looks like here in a second. And then also the other change was last year's kind of a pain point for us CPAs working on pass-through entities, partnerships and S corps. Last year had to pass through that credit to all the shareholders or partners, whereas this year we can take that credit right on the partnership return or that S corp return, or any business return for that matter. So it should simplify things a little bit from that standpoint, so the entity can actually take the credit versus having to pass that through. So just a reminder, on the website, the Nebraska Department of Revenue website, there's a lookup tool that you're able to put in all your information for the property tax paid in that year to generate a schedule that you can provide us that shows us exactly how much we can include on your Nebraska tax return for that property tax credit. We do have a webinar that Andrew and I did last year. We're going to see if there's any changes to the website. We might just email blast out last year's webinar just as a refresher on how to go out there and do that. Otherwise, we might do an updated webinar if there's any major changes there. But just an FYI, the lookup tool on the Nebraska Department of Revenue's website is still currently not available. Per the website, they're hopeful to have it up and running by Monday, January 31st. So stay tuned for that. So hopefully we can get that piece of information rolling so that we can start finalizing tax returns here the very first part of February. So that's one major change for the state of Nebraska. Another couple changes, the Social Security inclusion was reduced. So there's an act that came about here. LB 64 was enacted for 2021. So basically, it's going to reduce the includable amount of Social Security benefits you receive by 5% starting in 2021. Or if you're under certain AGI limits, they're fully excludable already. So if you're, for example, married filing joint and your federal AGI is under 59,960, you get to exclude all of your Social Security from being taxable on your Nebraska return. And all other filers, that's 44,460. So just a change there that they're going to continue to reduce the amount taxable on your Nebraska return, which is great. And then the other change on the 529 plans, basically certified trade programs that are certified by the U.S. Secretary of Labor now qualify for 529 distributions. So there's a change made there. So they're trying to help increase, people going into the trades and that aren't necessarily using it all on college tuition. We know how much college tuition is these days, and if you saved up a bunch for your kids' college and they ended up going into the trades, this is a nice helpful piece that you can still use your 529 for that. All right, cryptocurrency, virtual currency transactions. So it's been a hot topic here the recent few years. Continues to be a hot button item for the IRS. So with that, what we recommend and ask anybody that is trading cryptocurrencies, a lot of times we've noticed over the past few years that there's not good reporting coming from the brokerages or wherever you're, say if it's Coinbase or wherever that's at that you're holding that crypto. So we ask that there's different platforms out there that can help you get a report that shows exactly what your gain and loss is, which would help us from a reporting standpoint on your tax returns. So just be cognizant of that. There's a checkbox on the IRS or on the federal return. If you hold any cryptocurrency, we have to check that box. And then new for 2021, the state of Nebraska also has the same checkbox on their tax return, whether you hold cryptocurrency or not. So both federally and from a state standpoint, there is more oversight, more they're looking at that a lot harder right now. So just a heads up there.
I think one thing to add there, I think on the IRS form last year it said, do you hold cryptocurrency? I think this year it says, did you realize a sale? Something to that effect. So I know in the past they just wanted to know if you had any. And then this year it's, did you actually sell something to create a gain or loss? So, and then, yeah, Clint mentioned that most of these Coinbase or wherever you're holding those crypto assets, they normally have like a side service that can create a 1099B really quick and efficiently. I know if you pay for their service, it's going to be a lot cheaper than us trying to, dig through some of those records. So, right, yeah, it's a good point.
All right, just a quick update on retirement plan, refresher on that. For 2021, the limits for 401ks was 19,500. If you're over 50, there's a catch up of 6,500 allowed. For 2022 here, that they increased that by 1,000, so now your deferral can be up to 20,500. The same catch up amount is 6,500. IRAs are the same for 21 and 22 at the 6,000. If you're over 50, you got the $1,000 additional catch up that you can do. And then just a reminder on Roth IRAs, there's certain limits, but we can do Roth conversions and take a look at that for this coming year. And then also one of the things that was in that Build Back Better plan that was a little bit of a scare was doing away with backdoor Roths. So since Build Back Better hasn't passed, those are still now available for 2022. The plan was that those backdoor Roths were not going to be available starting 1/1 of this year. So that's a good thing. And then SEP or Simple IRA, other retirement plans for businesses, we'll talk about that here in a little bit. So on the estate and gift tax side of things, there's a lot of fear there too that the Build Back Better plan is going to change a lot of things there. That has been kind of squashed now for at least a little while. So for 21, the estate tax exemption total per individual is 11,700,000. So that's going to be indexed for inflation here for 2022. But just a reminder on these limits on the state side, they're still looking at sunsetting here, I believe, at the end of 2025 in the Trump tax law. And so still need to be thinking about what that's going to look like after 2025 and reevaluate your estate plan. So it's never too early to start thinking about that and planning ahead, because I know it can be when you get to that year of, it seems like it could be kind of a rush to try to figure out a good plan. So always be thinking about that, and if you need to talk about your estate plan, we'd be more than happy to help you kind of walk through it and considerations with that. The gift tax exclusion is 15,000 for 2021. It has jumped up now to 16,000 for 2022.
A few, yeah, charitable donations. I know we talked about this in that first slide. So there were a few changes here in 2021. So yeah, individuals who are single, if you send a check or cash to a charitable organization, you have proof of it. You can deduct 300 if you're single, 600 if you're married. And so that is a nice change if you do not itemize, just because, on a previous slide, we looked at our, standard deductions all the way at 25,000 this year. And so for most people, with the tax portion of that itemized deductions being capped at 10,000, it's hard to get over the 25,000. So this is a way to deduct charitable donations if you don't itemize. And so, yeah, 300 for single, 600 for married, filing joint. It does have to be cash or check. It can't be taken stuff to Goodwill. That does not count for this $300 or $600. And then, yeah, non-cash donations. If you are in the camp where you do itemize, save your non-cash donation slips, because we can deduct up to 5,000 of fair market value on those donations. So just another thing, if you are itemizing, make sure you're getting those receipts. Should be everything on there. Again, small business, we're going to kind of work into some business items now instead of the personal side. So small business, through the pandemic, there were a lot of industries that were hit hard, but also a lot of industries that, probably had record years. So there was a lot of influx for, small business retirement plans. So you can see a few of those examples here. You have your simple plan, your set plan, profit sharing, 401k plan. So if you do have some extra cash at the end of the year and you're trying to get some money funded into retirement, there are a few different avenues we can take to deduct those retirement contributions. And at the bottom, you can see there are some tax credits available for the first 3 years of most of these types of plans. So, again, it's just another incentive from the IRS to start these savings plans for you, your small business, and your employees as well. Another hot topic this year was the employee retention credit and some sick leave credits that we'll talk about. But the biggest thing here is this employee retention credit. So for most businesses, that ERC is what we call it, that shut off after 9/30 of 21. And so prior to that, you could take this employee retention credit if you had a drop in gross receipts or you were forced to shut down. So I know a lot of our clients, we've already done those employee retention credits for just standard businesses that had that drop in gross receipts or they were shut down by the government. So there was another type of employee retention credit that just came about. And so that's for the recovery startup businesses. So all that means is, if you started your business after February 15th of 2020, and, if that's the case, you don't have to meet this drop in gross receipts, or you did not have to be shut down by the government. And so instead of being shut down after 9/30 of 21, they can actually go through the end of 2021 to figure out this credit. And so the only stipulations to take the employee retention credit for these startup businesses is one, you have to be in business after February 15th of 2020, and you also have to have gross receipts of $1 million or less. So for most of our small businesses, that does apply, and it's a pretty huge credit. So it's capped at 7,000 of wages per employee per quarter. So yeah, it can be a big credit if that would apply to you. So again, if you went into business after February 15th of 2020 and you have gross receipts of less than $1 million, and you also have payroll paid to employees other than yourself as the owner. So any wages to the owner do not count. So we got to keep that in mind as well. Otherwise, it is a big credit. So if you think that situation does apply to you, let us know. We can take a look. Secondly, family and sick leave credits. So if you're a Schedule C person or you have a Schedule F farm schedule and you show a net profit in 2021 and you had COVID or you were forced to quarantine with COVID, you can take a pretty good size credit if you show net income. Now, if you show a net loss on that Schedule C or F, this credit does not apply to you. But it did amount to quite a few clients last year on our 2020 returns, as it was available then. And again, it's also available in 21. So With all the different variants, it's very possible you've had COVID once in 2020 and also in 2021. So again, this credit did shut off after September 30th of 21. So you would have had the virus before then.
Right, and the max on that credit per day is $511, and it's like Andrew said, it's based on your self-employed income. So the higher your income, the more you could potentially qualify for per day. But the max per day is $511 per day, and it's up to 10 days. So that can be up to $5,100. So it's a sizable credit there.
Right. Yeah. So if you show net profit of $2,000 for the year, this credit might be less than $100. If you show net profit of $80,000, this credit could be a couple $1,000. So it does depend there. Lastly, business meals are 100% deductible for 2021 and 2022 if they're if they're provided by a restaurant. So that includes like drive-through stuff, takeout from a restaurant, anything restaurant related is 100% deductible, whereas in the past it was only 50% deductible. So that does apply for 2021 and 2022, just to try to spur some of that growth in the restaurant industry.
Right. All right. So the looming legislation for the Build Back Better plan. So, as it sits now, it doesn't sound like the Build Back Better plan as a whole has any chance of getting through. It sounds like what they're going to try to do now is take bits and pieces from the plan that they think they can get through and try to pass those through individually or attach them onto some other bill here later on in 2022. So a lot of the things that we're fearful of as far as increased tax rates, it seems like that might be dead right now. They're talking about an additional surcharge tax, 3.8% on basically S corp distributable earnings if you're over a certain income limit. So hopefully that is now gone. And then also, we talked about the backdoor Ross. There's fear that those are going to go away. That doesn't seem to be the case. One good thing though that was in there that might find its way through, there's consensus on both sides of the aisle, is with the SALT deduction. So state and local tax, when you itemize, currently is capped at $10,000 for real estate taxes, state tax paid, those kind of taxes paid on if you itemize. They might be looking at upping that limit, which could be helpful if you are currently capped at that 10,000. So we'll just keep our eyes and ears open for that. So hopefully that might be a nice change here for 2022, but we'll wait and see. But otherwise, yeah, everything else sounds like it might be piecemeal. It's not going to be in its entirety. Joe Manchin out of West Virginia has helped squash a lot of these tax increases, so that's good. All right, so new this year, you guys have probably seen our rollout for SafeSend Exchange. It's our new platform for exchanging securely information with us. We thought it'd be a good time right now to go through some best practices, some things we're going through right now that we thought would be helpful for both us and you as clients. One thing, if you can combine all of your documents into one PDF file, you can, or if you can, you got separate PDF files, send all those documents at one time instead of piecemeal. A lot of times when those come in piecemeal, we have to individually handle them and move them out of SafeSend into our tax document file. So it just helps save us time on our end from touching things multiple times versus getting it all at once. And then secondly too, if you send everything at one time, we kind of know then that should be maybe 90 to 100% of what you all have for tax documents. We know it's ready to start on and we can get most of it finished. We always know there's going to be late stuff that comes, down the road, late 1099s, late information that comes in. That's fine if we need to get that later. But if you can, try to hold off on sending stuff through SafeSend for your tax returns, individual tax returns, business tax returns if you can, until you have most of it compiled already. And then also try to limit JPEG files too. When you take pictures, PDFs are preferred if we can get those. But we understand sometimes you're going to need to take pictures of things and upload those. So, but try to limit those if you can. And then just as a reminder, there's a couple ways to access the SafeSend Exchange so you can send us information. One is through our website. So if you go to our website and click on client logins on the top, it says secure file transfer SafeSend. So you can use that. Then we also have a link on our email signatures that includes a link to the Exchange as well. So if you have any questions on that, you can always call our office and ask for a staff member to help you with it if you have questions, but it's pretty self-intuitive. But yeah, if you have any questions, just let us know.
One thing to add, I probably did not touch on this. So we talked about the third stimulus payment. There should also be an IRS letter coming out showing how much you received for that third stimulus, the round of stimulus. So that was $1,400 per person. We should get a letter, letting us know how much you received, especially if you had a baby in 2021 or change of dependents. If that did apply to you, you would not have received a stimulus for that child. So, you could potentially get quite a bit more back if we have that letter, we can reconcile it to your return.
Right, and the other confusing thing on that too is, you receive that $600 per person stimulus in January. Just remember that one related to the 2020 tax year, even though you received it at the first part of 21. So we'd just be talking about that third stimulus that came out around the March timeframe. It should have been around 16. It should have been 1,600 a person max, because they try to get everybody whole to that 2,000 per individual between the two. So just be for the one in March that we're talking about.
Yep. And I know the IRS has come out and said if your return is held up this year, it's most likely going to be because the child tax credit and that stimulus check. So if we can nail those two down, we shouldn't have any returns that are held up. Just because I know the IRS is still processing some 2020 e-file returns that should have gone through already. So we just want to limit those situations.
Right. Well, looking at the chat box here, I don't see any questions. Do you, Andrew?
Nope, not so far.
All right, then with that, we'll leave it there. But if you have any questions, feel free to reach out to us, email, or give us a call if anything comes up. But appreciate everybody's time this morning. Hopefully this was helpful, just kind of give you a refresher on the different tax law that we've been discussing in the past, and also the new items we're dealing with here for 2021. So once again, Andrew and I, we appreciate you guys' time, and have a good rest of your day, good rest of your week. Take care, everybody.
Thank you. We'll be talking to you all soon.